Hello, everyone, and welcome back to the G360 Podcast. Today, I am joined by our founder, Samuel Diarbakerly. Sam, it's a pleasure. How are you?
I'm doing great, Rex. We've worked together for many years, and you still can't pronounce my last name, but don't worry, nobody else can.
I'll work on that one. But today, we're talking all things concentrated stock position. So Sam, I want to open up by simply educating our clients of, if they're not familiar, what is a concentrated stock position?
I think, Rex, this is a topic that's going to resonate with many of our clients, as many of our clients are corporate executives and hold concentrated stocks in their company stock. I think what's important to highlight that we want to focus on this conversation is appreciated concentrated stocks, which will really kind of nestle in nicely to talking about tax strategies to how to diversify those stocks and not only de-risk, but do it in a tax-efficient manner. So typically when we think of a concentrated stock, we start thinking of a single asset that is more than, let's say, 10 to 20% of a family's net worth, which starts imposing risk on their portfolio, not just their portfolio, to meet and observe their financial needs. So when we think about what the challenge is of having a concentrated stock, it's typically not owning that stock. If you own $15 million of Amazon and you have a $15 million basis, well, you can just sell your Amazon and put it in your pocket and do as you please. Typically, the issue is you own $15 million of Amazon and you have a $1 million cost basis. That means the delta between what you have paid for the stock or what you were vested at and what the current market value is a taxable gain. And when you sell that position, you will recognize a capital gain. If you hold the position for more than a year and a day, you will be taxed at the favorable long-term capital gains rate, which is typically around 20% plus some state taxes. If you hold the stock for less than a year and a day, you're going to be taxed at ordinary income, which can be quite penal, especially as many of our California, Massachusetts, Maine clients may know that, you can start looking at a pretty significant tax bill there. So think about that example I gave you of $15 million, $14 million gain. You don't want 6 or 7 to go to the IRS in your favorite state tax commission.
And so we see a lot of our clients that are coming to us with this challenge. In a lot of these cases, what are the scenarios of how do they get to the point where a stock position actually becomes a concentrated position? You mentioned it's mostly from stock compensation. Would you say that's the majority of the way that these positions become so appreciated and so concentrated of their family's wealth?
I think so. And taking even first step back, Rex, I think it's not only how did they get that position, but how did they get to us? Mm-hmm. Most of the time, it's through a referral of an existing client because they're talking about the savvy and sophisticated plans that we put together. And the first thing that we'll hear is, I accidentally sold disqualifying disposition stock and I got a surprise $1 million tax bill. I never want that to happen again.
Right.
So typically what we see, when the client ultimately gets to us is something probably not great has happened along the way that they did self-directed or with a prior advisor. But typically, because of the complexity of stock plans and non-qualified stock options and ISOs, which we will have separate podcast episodes for, so I encourage our listeners to be sure to tune into those with our subject matter experts on those. Clients tend to just do nothing. They let them accumulate, and then they see that there's a gain, and they're not quite sure on what the best strategy is. So over the course of years, these are really busy corporate executives, high up in management, where they're working many hours, focusing on their family, and they don't have quite the time to dissect their E-Trade account. And ultimately, they start acquiring significant amount of their company stock.
Great. And so, when we get to that point, let's say, I'm John and Jane Smith, I work with a CPA, or I've been referred to Generation Capital Advisors, and I'm at the point where I'm now sitting in an introduction meeting with you, and I'm disclosing the fact that my company stock might make up a significant portion of my family's wealth, or it might be a risk that I'm not willing to continue to take. So what are those risks, or what are the biggest risks that you see when we're sitting down and in the fact-finding phase of either working with prospects or referrals? What are the biggest risks that you think they face?
Well, I think the first thing is I don't know, 98% of the people that come to us don't have a written financial plan. So the first thing is, the biggest risk is what happens if the stock goes down? And what happens if it goes down significantly? If you have a $4 million net worth and $3 million is in your company stock, the stock goes down 50% for any given reason, that's going to hurt. That's going to impact your retirement plan. It's going to impact your philanthropic goals. So the biggest risk is derailing your financial plan. And as corny as it sounds, and all of our clients and employees may be familiar with, the first thing that I have always been taught and drive in to our clients is, let's start with your financial plan. Mm-hmm. What happens if we do a scenario analysis and your position is down now 20 or 30%? Right. How does that impact your cash flows and your other financial goals?
Right, absolutely. So step one would be to determining, what your financial goals are, and then doing a full analysis as to where you are and a health check as to where you are right now, and then building a process and putting a process into place to getting you into a proper financial plan so that we can create a roadmap of ways to take the first steps so that we can meet those goals, and ultimately to de-risk any of those challenges that you might be facing with a concentrated stock position. So I want to take that to sort of segue into the next steps, right? So we've met with an advisor. We know what our goals are. We've implemented a really strong financial plan, but we know that one of the ways that we can derail that financial plan is if that stock moves against us, or that concentrated stock moves against us. So what I want to talk about are some of the strategies that we use, because I think, candidly, that is one of our specialties at Generation Capital Advisors, is working around concentrated stock positions and highly appreciated stock positions. So, from its simplest point, Sam, what would you say is the most simple option for a client if they want to simply de-risk?
Yeah, I think the simple option is to sell the stock. Right? Punch it in, sell it, take the cash. When you're engaging in that simple step, it is critical to take the admin step to make sure that your stock plan or your brokerage account is completely reconciled and the cost basis is correct. Mm-hmm. Can't tell you how many times, well, I can because you see it every day, how many times, we see zero basis sales, and now we're doing fun Excel projects trying to figure out, what day was this granted? When was it vested? Oh, there was a stock split. Oh, it was a half cash, half stock split. So simple option, sell the stock, put a market order in, take the cash.
Yeah, I think that gets a lot of, I would say, I don't want to say hate, but I think it's often overlooked, where if you want to simply, if it's keeping you up at night, the amount of risk that you're taking, having a bird in hand and just paying the taxes is the simplest way to reduce that concentration risk. And you know exactly what's going to happen. You know exactly what the tax bill is going to be. And I think it's often overlooked. And sometimes that's actually how a lot of our folks actually get into the concentrated position, is because they're worried about that tax bill.
Yeah, I mean, it's simple math, and it's kind of funny. It does get a lot of hate. It's like, say it a million times. Simplification is the ultimate form of sophistication. Sell the stock. You can do the math on your iPhone. Take your federal, your capital gains bracket and your state bracket, and then do the math. Okay, if the stock goes down X percent, versus what your tax bill is going to be, well, there you go. If you want to go up the sophistication scale, well, maybe you can put some limit orders in. I will give the caveat, many of our clients who have concentrated positions are actively working at the company that they work at. So compliance. Make sure that your HR or general counsel, you're in an open window. If you do need approval from general counsel, make sure that you work with them to get approval on those lots, because you don't want to be unwinding those if you accidentally make trades you shouldn't. So just a call out for there, another critical matter when navigating, especially the stock plan.
Absolutely.
Sell the stock. If you have a number you like, put a limit order in. Easy peasy, reconcile it, pay the IRS and your state taxes, and be on your way.
Great. So that's, sort of step one, the easiest and most simple solution that we can encounter to reduce that risk. What about for a client who, per se, has a significant portion of their assets in a concentrated stock, but they're looking to gain index exposure, but they don't have the liquidity right now to fund index investments? So can we talk a little bit about what long-only direct indexing is and why it may be beneficial for someone that has a concentrated position or for someone that just has a highly appreciated position that they're looking to get out of?
Yeah, so direct indexing is probably the first place that we'd point a client in to start diversifying their stock tax neutrally. So the first thing is, let's think about when capital gains get triggered, right? In the year that they're realized, you will owe them in the next April, or for many of our clients, October, when they finalize their taxes. So when we think about long-only direct indexing, I always like to tell folks, if you've ever been to a dinner party and you get the deconstructed meal on the cutting board, it's all opened up for you. That's what direct indexing is. It's managed by a professional provider, and you pick an index. Typically, we like the S&P 1500, the total U.S. stock market, which is about 90% S&P 500, but you can do the S&P 500, you can do the NASDAQ, you can do whatever made-up indexes they have this day. You can do the international low volatility, high dividend, high quality, upside-down factor index if you'd like. I don't know if you'll make any money, but you can do that as well. This is really a technology and an engineering problem. So what the direct indexing strategy will do, depending on the provider, they'll buy 300 of the 500 S&P positions with the first mandate of tracking the index. So they will have a stated tracking error. Typically, it's 1%. We always like to tell clients, tracking error of 1% doesn't mean necessarily if the S&P is up 1, you could be up 11 or 9. That is geometric. So it could be a little higher of a delta. But what we have seen in all of the providers that we've used over many, many, many years is that they typically track that index pretty tightly. So along the way, there's a bench of securities that are on the bench that are not in the portfolio. If, for example, Coca-Cola is down, they will sell Coca-Cola and buy Pepsi and recognize a loss. So the first thing clients will say is this strategy trying to lose money? The answer is no. The first thing the strategy is attempting is to track the benchmark. S&P is up 10, you should expect to be up around 10. S&P is down 30, you should expect to be down about 30. Now you will recognize a tax alpha benefit by those recognition of losses. So the first mandate is to track the benchmark. The second is to realize capital losses. How that integrates into the theme of this podcast and what we're talking about is offsetting those capital gains. So if you recognize $10,000 of losses in your direct indexing strategy, you can then sell $10,000 of gain in your concentrated stock, and that will be a tax neutral transaction.
Right.
Now, in the spirit of this podcast, we love to challenge each other and talk about the pros and cons, and you'll hear, me say a million times, there is no free lunch. This is a tax deferral strategy because ultimately the basis of the direct indexing strategy will come down over time. You will log into Fidelity or Charles Schwab, and you will see a whole lot of green, and there will be nothing left to sell. And we will either need to add capital to the account to re-energize it, or you take that account to the grave with you and you get a step up in cost basis, and then that completes the tax-free effect of that transaction.
Right.
So typically we don't put a planned death in our tax strategy.
Right. So, we get a lot of questions, especially of why should I direct index as opposed to owning the index outright? And the reason being, or the way that those losses are uncovered, are simply because instead of owning an ETF, which is a basket of underlying stocks, we're actually owning the underlying stocks outright. So as Sam said, if Pepsi is down, we can harvest those losses and take someone off the bench to remain in exact exposure and help limit that tracking error, and really allows you to take advantage of the stocks that don't move in your favor. And at any given point of time, there are always going to be stocks that go down for any given reason, right? And so we can use that as an opportunity to one-for-one match up with the gain that you have in your appreciated position. So it's a great way, again, the first step, if you want to remain invested in the index and generate some tax alpha, it's a great way to do that. So what about the next thing of, I'm John and Jane Smith, and I'm really worried about the downside, right? How can we utilize hedging to help protect my concentrated stock position? Okay, so now we have a great understanding of what long-only direct indexing is. What about for our more affluent clients that per se want to take the loss harvesting up a notch and have highly appreciated positions where we can utilize the timeline of a full year and some other liquidity that they may have in their portfolio to fund a long-short direct indexing strategy. Talk to me about what the differences are and why there may be some benefits, but also some extra risks that come with utilizing a long-short direct indexing strategy.
Yeah, I feel like every time I log into LinkedIn, all I see is commentary on 130/30 and 200/100 strategies. So this is the kind of the next level of how you would kind of work to unwind these types of strategies. So take that direct indexing construct, and now we're going to apply two factors that will add some financial risk to the portfolio. So we have to be cautious of that, but hopefully that financial risk is less than the risk of the concentrated stock. So we will engage a manager to impose what we would call like a 130/30 or a 200/100 strategy, where you give them $1 and they will buy $1.30 of stock and short 30 cents of stock. So by adding leverage and shorting, the manager will be able to harvest a significantly higher amount of losses. Think in a 130/30, if you fund it with $1 million, you should be kind of targeting $300,000 of capital losses in that first year. So that's a really powerful strategy. There are many, many, many managers that do this. We've kind of closed our list to about 2 of those managers that have shown sophistication and a long track record of executing on that strategy. But what that will allow you to do is further unwind that strategy with higher speed and greater tax loss offset. So in a 130/30 strategy, same construct, you will track that index very closely, but you will add leverage and shorting to the portfolio. Now, let's talk about the no free lunch. Now you're taking some risk because you're borrowing money, right, on the long side. And there's also some additional costs. At Generation Capital, we've got pre-negotiated costs with these third-party managers, and candidly, they're still in the same cost of an index fund. Think 30, 35 basis points. But there is margin cost, which is all pre-negotiated. But those are things to think about. You're adding complexity. You're going to have many hundreds of positions in your account.
Mm-hmm.
But and you take that farther along the leverage scale. Now, if you go to 200/100, you can, garner, 65, and more leverage. You can garner 80% of the principal value of the account and capital losses. Along the way, as I alluded to in direct indexing, we need to be cautious and cognizant of how we're going to unwind these strategies, because of the alpha model in some of these strategies, you will have some significant appreciation and could have more appreciation in the account than you have value in future years. So all sorts of things to unpack that we'll dive into on individual podcasts. I know you're meeting and hosting Invesco for a 130/30 podcast later this week, which our listeners will greatly enjoy, Jeff Murphy. But that is a really savvy and popular way to unwind a concentrated position. And I will say the first thing you want to do as well when we talk about the plan is really evaluate the position. I think there's a lot different notion of how quickly families want to get out of their position. When you're talking about a Walmart or a Microsoft or a Broadcom, something with a healthy footprint, free cash flow, a large cap core position, versus a mid cap value stock or a small cap growth. That really will differentiate on how quickly families want to exit their position.
Right. And the great thing about these strategies, both long only and long short, is there's so much flexibility for us to find the right solution for our clients, depending upon the risk factor that they want to take, depending upon if we do want to introduce margin, is it a very small amount? Do we want to adjust the beta, or what we call the risk to the overall market? So there's plenty of flexibility around these. It's just important for you to work with your respective advisor and making sure that we know exactly what your goals are, what you're worried about, and ultimately how do we match that up with the best direct indexing strategy for you. Okay. So with that said, I want to move a little bit towards the hedging side of things. So I'm John and Jane Smith, and I have a really concentrated stock position. And for whatever reason, I'm now a little bit more concerned. We might have had a really good run up where the stock has appreciated, very significantly and very quickly. And now I really want to protect that nest egg that I have built, right? I took some risks to be able to earn the upside. And Sam, now I'm looking to protect or hedge on the downside. what are the most efficient or what are the best options that we tend to implement with clients in terms of hedging our concentrated stock positions?
Yeah, I'll go to the most popular one because, we can go to like upside down, put spreads and all this complicated options nonsense. But we'll have Jake on a future podcast to talk about each strategy. But typically the one we see is and implement a lot. Keep in mind, you cannot do this strategy if you're an employed corporate executive because you typically can't hedge the position while you're employed, but is a cashless collar. In that strategy, we sell a call that caps your upside, and we use that premium to buy a put. So it gives you a more predictable outcome on how your position will trade. That strategy was kind of made famous by Mark Cuban in the early 2000s by running a collar on Yahoo. And when the dot-com bubble hit, he was able to protect his wealth by those put options. So buying that put option is basically buying insurance, and the premium you collect from the call option will fund that, so you don't have to have a cash outlay. All these strategies we're talking about can work individually in a vacuum or together. Like you could use long-short direct indexing in a collar strategy separately in different accounts or together for an individual client. The time we're recording, where are we? November 6th. We're almost at the end of the year. For many clients, it doesn't make sense to recognize a capital gain in December, where we can wait till January and let those direct indexing or long-short direct indexing strategies continue to harvest losses. So that's a good way to buy yourself some time with the downside protection in case things go awry and we don't get the Santa Claus rally this year.
Right, exactly. It's a great way for us to do some proactive tax planning where we can protect or quote unquote manufacture as close as we can an outcome that our clients are comfortable with, while also giving us, if we realize that gain in January, a full 12 months to work backwards and to really save them on taxes. So the options market and, hedging in general gives you, again, a lot more flexibility around what are you looking to de-risk and how can we diversify, and with what areas and what tools in our quiver can we use to best provide a really good solution for our clients. So again, just important to make it known to your advisor what your goals are, what you're worried about, and how do we look at your financial plan and create and craft a solution to hedge out some of those risks. Okay, so we're now experts on direct indexing, on selling and paying the taxes, and hedging. Let's talk about exchange funds now. I think exchange funds often don't get the light that direct indexing gets, but can be extremely powerful tools for simply, I would say our ultra affluent clients that are looking to put a piece of their pie into a larger fund and get a diversified basket back. So can you give us a little bit of an example of what exchange funds are and what the use case is?
Did you mention pie? Because I'm going to get into my tailgate analogy for exchange funds.
Let's do it.
So I will say to our listeners out there, some of these strategies have different qualifications, and I will not name any of the managers who implement these exchange funds because this is what we call a qualified purchaser investment, meaning that the clients need to have $5 million liquid in their portfolio to be recognized as a qualified purchaser. Typically, these exchange funds have higher minimums, think around $1 million. So how an exchange fund works, and I'll give my tailgate anecdote to explain to our listeners how this works, is everybody comes to the tailgate. I'm going to bring mac and cheese because I'm, feeling really good about myself. Rex, you're going to bring a salad because you're a little more healthy than me. And then everybody's going to bring something to the tailgate. And in return, you're going to own a share of the tailgate. So think about that with your stocks. We're going to go to a marquee manager. We're going to bring them J&J or Procter & Gamble that's highly appreciated. And in return, we are going to get a limited partnership interest in the exchange fund. So you're going to get instant diversification. And the goal of the exchange fund, when everybody puts their tailgate food in, is to get replication of the S&P 1500. There are some tax rules where there needs to be a little bit of real estate in there for diversification's sake. But that is a great way to get instant diversification. And in turn, The strategy with exchange funds typically tends to be run direct indexing or long short direct indexing all alongside of it. And then you're going to want to take that to the grave with you, Rex, and get the step up in cost basis. But that's typically what many of our ultra wealthy clients do to get instant diversification. There is more complexity with the exchange fund. They are liquid. They tend to have higher costs, but they do work extremely well for getting that instant diversification. And many of the institutions that are running these strategies have added increased bells and whistles to make up for some of their higher fees. Like, for example, all in one, you can lend off your exchange fund. So those are some of the unique features of the exchange fund. The 351 ETF exchange is garnering more popularity as well. That's getting a little more simple. So rather than taking the LP share, you can actually get a share of somebody who's seeding an ETF. So in return, you're not getting away from your basis. After 7 years of the exchange fund, you can get a basket of stocks back. Whoever brought their mac and cheese, I can take your salad, but I'm getting my prorated basis back. So again, I think as we start to approach the end of our conversation, Rex, we see it all day. Everybody's individual. One of the things we may struggle with is because we get so many referrals, our clients are doing different things. And they ask us, well, why am I not in this strategy? Or am I not in this strategy? It's because everybody's individual. There's different risks associated with this. And it's important to work everything holistically in a playbook. And that's why we've released our concentrated stock playbook so we can memorialize these plans. I'll tell you, one of the hardest things about managing concentrated stock is typically one of two things happens, right? Stock goes up or the stock goes down. And when the stock goes up, all the strategies we're talking about are diversification and de-risking strategies. So if you have a high beta stock, it's hard to stick to the plan. But studies show stocks tend to not go up absolutely forever, and there is mean reversion. And that's why it's important to integrate your plan, your financial plan, with your concentrated stock plan. Because for many of our clients, we always ask them a question, what will happen if your wealth would double? Most of our clients say nothing too much. We really wouldn't change our lifestyle, to be honest. Well, what would happen if your wealth was cut in half? That changes things.
Absolutely. So, the last strategy that we have here really is for our clients that are more charitably inclined. And this goes back to, coordinating with the financial plan, but also sometimes with the estate planning side of things. Talk to us about how we can utilize a concentrated or highly appreciated security or position in our portfolio to really maximize what we're doing in terms of charitable giving and helping to fuel or fund the charities or nonprofits that are most held closely to our clients and families that we work with.
Yeah, I'm kind of thinking of the Bart Simpson on the chalkboard. Cash is the worst asset to give. Write it 1,000 times. Cash is the worst asset to give. So let's kind of think of the easiest way. You can give your appreciated stock directly to a charity. So what that does is it avoids the recognition of the long-term capital gain or the short-term gain. We always want to give long-term gain. You can reference our GCA tax guide for why you want to do that. More administratively friendly, you can revert back to an earlier episode of Fidelity Charitable with Kyle, which I thought was a great episode, if I don't say so myself. But you can very easily move your position into a Fidelity Donor Advised Fund, which is a public charity. And then Fidelity will then, you can go on their wonderful portal and just in seconds distribute that stock. So by donating appreciated stock to a public charity, you avoid the long-term capital gain, and you get the ordinary income deduction. Now, I'll be brief in kind of many other strategies because we will have individual episodes on all of these different types of entities, but there's also, you could have a private foundation. It's a little less tax efficient than the public charity, or some very savvy techniques depending on your overall situation and your goals are leveraging a CLT or a CRT, a charitable lead trust or a charitable remainder trust. And that will allow you to avoid capital gains tax, create a legacy for your family, and create an income stream for yourself or for your charity in your lifetime. Those kind of work in reverse. So those are the limited, I shouldn't say limited, but many strategies that you can use for concentrated stock. I think, as you've alluded to, the simplest way is sell the stock outright. You can get into collars and exchange funds and long short indexing and charitable giving. Many of our clients do all of them at once. But Rex, maybe I'll ask you and flip the question, because you're working with many of our accumulating clients or G2s, and many of your clients are working at asset managers and they're really savvy. What do you think that the biggest challenges for accumulators are when navigating their company stock?
Yeah, I think it's a common question as to, are you okay with concentration or are you seeking diversification? Because as an accumulator, I think Bogle most famously said, concentration builds wealth and diversification reserves it, right? And preserves it. And so it's that common back and forth of that we don't know what the future is. And it really just depends on how confident you are. And obviously we don't know what's going to happen with the stock. But if you're not willing to take that risk, then we need to look at these strategies. And, a lot of my clients specifically have unrealized or unvested exposure, which they don't think is actually exposure, but it is. And so that's the biggest challenge that I see. It's just, how do we balance that exposure and make sure that we're really in alignment with what your goals are and what your financial plan says. And one of the most common mistakes that I actually see with my clients is when they are ready to de-risk or take a little bit of the chips off the table, they just go in and they pick a dollar amount that they want to sell, and they just plug into their E-Trade or their Morgan Stanley, wherever their stock plan is. And they don't think about lot management, which is extremely important when you have a concentrated or appreciated position, because you have to look at the way that you're selling, whether it's HICO or FIFO. And all that basically means is you want to be able to specify which lots you're selling so that you're not increasing the tax liability that you have when you do de-risk. So that's why it's just super important, whether you're meeting with Sam, myself, or one of our other team members, make sure that if you're ready to pull the trigger and take some risk off the table, that you're doing it with us together and you specify the lots and you make sure that you're thinking about lot management. So that's one of the biggest challenges that I often see with my clients, but more importantly, one of the biggest mistakes that happen before people start working with us is not thinking about lot management. So as we close out our conversation, Sam, I have one question for you here. Can you just share a case study or an example of a family that's come to us with a concentrated stock or a really appreciated position, and a success story of how you've helped them either diversify or reduce risk or significantly reduce their taxes?
Yeah, I think I'll give maybe two anecdotal examples of families that we've worked with. One is a family that just simply wanted to de-risk, and they were okay. And what we did was work together and create a program which included a long short direct indexing strategy and a collar strategy. And along the way, the stock moved up once significantly and moved down once significantly and then moved up again significantly. And what we did along the way was we kind of set some price targets of where we wanted to execute that stock at. Mm-hmm. And even though the stock moved up eventually past that price target, we were up $60, $70 a share higher than where we ended up wanting to do it. And that family understood that, hey, we were engaging in some hedging techniques. But what we did was able to move out of a multi-million dollar gain of a position tax neutrally. And that is going to create significant wealth for this family and peace of mind. And this particular family, they don't want the risk. And when we work with another family that was okay with more risk, and what we've done is left the position unhedged and slowly started taking off $250,000 a year of gain management with a 130-30 strategy. And that stock has been appreciating significantly, many hundreds of percent. And now we're reevaluating where we want to go. So the answer doesn't necessarily have to be sell the stock. The answer needs to be is what's the outcome you want? Like, are you okay with this stock going down 60%? Mm-hmm. Okay, well, let's leave it uncapped and let's let it ride. So I think in those client stories, success looks different to everybody, Rex. And some clients, they want the upside and they want to chase those returns. And hey, more power to them, because a lot of those stocks, have been appreciating the last 5 years, right? With the regime in place. So, I think that everything looks different for all clients, but everything is the same. At the end of the day, we're dealing with people, and people have goals. And the first thing to do is implement those financial goals through a cash flow analysis and then back into what we should do with that concentrated stock. I'll tell you, the worst thing you can do is pivot halfway through. I've learned many lessons over the course of my career, and every time a client pivots off their hedging strategy, say, you know what, I changed my mind. We say, are you sure?
Yeah.
Are you sure? And then ultimately the stock comes down, and then you re-engage the hedging strategy, and then you miss out on a lot of the benefit of the strategy because now you're re-hedging it at a lower position. So it's all the same, Rex. It's all different, but it's all the same. And at the end of the day, you know what? If you look back in the last 30 years, hanging out in the S&P 500, a cap-weighted index is just fine, and we can do that in a tax-efficient way. And most of our clients are coming to us with wealth. They, as you alluded to, they want to protect it.
Right. Absolutely. So I think, the common theme that we're seeing here is that we will find the right solution to help create a roadmap and a financial plan to help your family and to make sure that if there's risks or anything that's a challenge that's concerning you, talk to us about it, and we will put a strategic plan in place to get you there. But what's most important is that you be proactive, right? Even as you said, the answer might not be to sell the stock today, but it's important to be proactive and think about what's going to happen in the future so that we can utilize the tools in our quiver to help set you and your family up for a positive solution. So Sam, to close here, if someone listening and I found myself or my family with a concentrated stock position, either it concerns me or I want to know what my options are, what's the best step to take in terms of thinking about some of the strategies or working and partnering with GCA to develop a plan? What's that first step that they should take?
Yeah, I think the first thing is if you want to reach out to us, you can, what do they say? Like and subscribe. Go to generationcapitaladvisors.com. There's a contact us. You can reach us. Our phone number is on there. There's, you can email us. Our information is linked in the bio here, but just give us a call. We'll come to you with a friendly educational attitude and you can provide an educational session. I think the number one thing clients can do is educate themselves, learn about the strategies. There is no free lunch. So let's talk about what the pros and cons are and let's set up a meeting. And, we're happy to meet with you, but if you're working with an existing advisor, ask them, be like, what is your philosophy on concentrated stock? If they don't have one, run for the hills. We were happy to work with you, but the first and foremost is just get educated, understand what you have and where you want to go.
Yeah, absolutely. And at GCA, we live by our famous acronym every day, passion, education, and partnership, right? We're extremely passionate, obviously, about helping families and helping listeners out there that do find themselves with concentrated stock positions. Super important for us to educate you on everything that can go right, everything that can go wrong, what the pros and cons are with each of these strategies, and then ultimately finding a partner that's going to be process driven to get you to implement the right solution so that we can take care of your family. We take this responsibility very seriously, and we always appreciate the trust that our clients put with us. Sam, thank you so much for your time today. I hope our listeners had some educational moments from this. If you are a family that does have a concentrated or appreciated position and you find yourself feeling lost or you're worried or concerned, please feel free to reach out. Look us up at generationcapitaladvisors.com and feel free to schedule an introduction meeting with us. All right, everyone. As a reminder, please hit that subscribe button. We have lots of great podcasts coming soon on all sorts of different topics with subject matter experts, and we're looking forward to bringing more content to you in the future. Thanks, everyone, and have a great rest of your day.
Thanks for listening to the G360 Wealth Podcast. If today's episode gave you something to think about or act on, share it with someone who might need it. Don't forget to hit subscribe so you're always in the loop. If you want to learn more about how we help families like yours simplify and grow their wealth, visit us at generationcapitaladvisors.com. Until next time, take care and keep building. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Generation Capital Advisors. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Investment advice offered through Integrated Partners, doing business as Generation Capital Advisors, a registered investment advisor. The information in this material is for general information only and is not intended to provide specific advice or recommendation for any individual. Integrated Partners does not provide legal, tax, or mortgage advice or services. Please consult your legal or tax advisor regarding your specific situation. All investing involves risk, including loss of principal. No strategy assures success or protects against loss.